spooking a lot of markets, including our own. Hartmut Issel, the head of equity and credit for Asia Pacific at UBS, joins us all the way from Singapore to talk about that. Hartmut, good morning. There's been quite a bit of a collapse in markets where you are close to. What's going so wrong?
I think as far as China is concerned in particular, and that market is weak this morning, I guess after the GDP figures, and there were a couple of rays of light in there, if you will. Yeah, so industrial production didn't look so bad, properties didn't look so bad. And now you get on Friday some of the private vendors, PMIs, so lead indicators, quite a bit below 50. That didn't look so well. And then also industrial profits this morning, weaker than expected for China, actually slightly falling. So that was a bit of a dampener, especially here on the China story, after we thought we had seen a bit of a stabilization in the second quarter Q2 number, in the GDP numbers in the second quarter.
I'll come back to this global growth fear in just a minute, Hartmut. In India, we are belaboring a more domestic issue. A lot of foreign investors participate in Indian markets through what are called participatory notes. They can buy them without registering in India as a foreign investor. On Friday, a black money investigation team said that we will look at the final owners, or at least the regulators should look at the final owners of these notes. Nothing immediate is expected. We had a government secretary telling us that they won't take any knee-jerk steps. But is this a cause for worry? Did any clients call you?
Haven't called me personally, and I think we also can take maybe a page here from also the government's response. The last time we had, a couple of months ago, we had these tax discussions, and I think the government as such made it very clear that as far as they're concerned, right, any legitimate sources of funding that come into the country, they have no intention or no desire to block, and anything that might not be, of course, naturally they would take action. So as far as international investors are concerned, we have the routes open. Our investors can invest via funds or the likes. So I think as long as it's clear from the government that stands, look, anyone legitimate is welcome, is free to invest. I do not think it will be an overhang for the market.
Okay, that's a major relief coming from a person like you and from where you are seated. Now to come back to the global growth issue. Is there something we should worry about? Because even the Dow Jones Industrial Average, the other Wall Street indices, and the non-Chinese markets in Asia are showing red ticks for the past week almost. Is there a growth scare, and will that start impacting Indian indices?
Now, maybe if we go outside Asia quick, some of the lead indicators also in Europe a touch soft, but I think that has to be taken with a pinch of salt. Some of these indicators, at least, have been taken around the time when the Greek situation wasn't resolved yet. We think, generally speaking, underlying trajectory in Europe is favorable. Of course, it's not a high-growth region by any means, but that recovery that we saw since after 2013 remains in place. And I think as far as the US goes, that is probably more on a micro level, so more corporates rather than macro, I should say. And yes, it's nothing unexpected in the second quarter earnings season. We do see the headwinds from the strong dollar, and we do see the headwind from the still year-on-year relatively low oil price, and they will only start to go away at a very gradual pace. They're probably going to stay with us for most of this year. Yeah? But perhaps interestingly, what we've done on the corporate side, earnings side for the US, we analyzed what would happen if we take especially that oil effect from energy, from falling energy sector earnings. If we take that effect out, we think this year we would still be 8 to 9% up on earnings. So I think we need to distinguish between, yes, an effect that is real from the energy sector, but it doesn't necessarily mean that the US economy is weak.
What about the global equities as a whole for the rest of the year, Hartmut? Do you expect this global equity downtrend to continue? And if there is price-wise correction, what could the extent of the downside be?
Yeah, I think we need to differentiate between different markets. Overall, we were positive or risk on, let's put it this way, but we certainly have very pronounced overweights, and we would really, on the equity side, advise investors to look at these. So Europe has been for a while by far our strongest overweight, and actually so far it's also one of the strongest markets really. What we have also upgraded just a few days ago is Japan. One of the reasons is also we see, from this revised codes of governance, we could potentially see something like we have seen many years ago in, say, countries like Germany, countries like France, when all these cross-shareholdings are starting to unwind within the domestic companies, and return on equities starts to go up. So we think particularly interesting stories here on the equity side we find in Europe or Eurozone, and more recently also Japan.
Okay, in that case, what's your pecking order globally in terms of equity markets? And within emerging markets, what's your pecking order?
Pecking order, very clearly, on the equity side is Eurozone. That's by far the strongest overweight, and then that's followed by Japan now. And let me come to emerging markets and also about India, where last time I was on the program said that this is our highest overweight. Now, we're still overweight in India, but we have actually cut that weight down a little bit, and I think for good reasons. Because it was a bit silent, or people, maybe in India people took note, but maybe outside not so much. India's actually, since the 8,000 Nifty levels, when we put a very strong case out why we thought this was an overreaction to some of the concerns. And in the meantime, maybe if you take today out, but we've recovered all the way up to 8,600. And we thought, okay, this more adequately reflects again the earnings trajectory that we will see more towards the end of the year. Right now we know it's a bit weak anyway, but the worst base effect actually on earnings is this quarter, and afterwards they get more benign, so it's easier to show better growth numbers. So India still certainly has a couple of aspects to go for it, also looser policy that we still expect. But we also need to take, or we need to acknowledge the fact that it has outperformed and also recovered in absolute terms. So in our strategies we have just cut the weight a bit, still overweight. Other key overweights that we have or one overweight that we have still is Taiwan. So actually more of a story that's connected on the equity market side, closer connected to the US recovery.
Just one final question. You were talking about the worries in China. Do you expect further derating of the Chinese and the Hong Kong market? And do you think it will be restricted only to those Asian markets, or do you see a snowball effect into other markets as well?
We need to distinguish the H share market, so the Hong Kong listed China shares. We must say, after we had seen this correction during the summer, it starts to look like good value. The macro is a bit mixed, I have to admit that, but those stocks aren't really expensive anymore. A share is a different story, and the fact that also maybe somewhat artificially that the government is trying to prevent maybe another clean out is not necessarily that encouraging, but on the H side, not unattractive, I would say. Now, when it comes to contagion, we looked at a couple of channels for potential contagion. So if in China we should see more weakness, or including a stock market weakness, how much would that affect the other countries? And I think you're really speaking about the neighbors more than anything else, because we have seen in the last correction that countries, especially like India, for example, but also others, Indonesia, they were in ASEAN in general, wasn't that much affected. And the channel, if you just look at the profit pictures, in all of the Asian markets, the highest you find are the neighbors with some 10-12% direct sales exposure to China. Yes. So unless you really have a massive hard landing, which we think the likelihood is relatively small, the contagion is, I wouldn't say there is no impact, that would not be realistic, but the impact can be contained.
Fair point. Hartmut Issel, pleasure speaking with you. Thank you very much for joining us with your thoughts this morning.